The Federal Reserve lowered interest rates. Or did they? Let's talk about it on the weekly update. Okay, friends, let's talk about rates dropped? Question mark. Here's what you need to know. First up, the Fed cut rates. So why are mortgages rising? And what we're going to talk about today is we're going to talk about this effect where the Fed only controls the short end of the curve, but the long end of the curve, where things like car financing, mortgage rates, furniture financing, the important stuff that we want to stimulate, that stuff really isn't in the Fed's control, and we'll take a look at it. First up, though, let's do the S&P 500. This is the same way we've always been looking at it. Red is the S&P 500, orange is the 50-day moving average, purple is the 200-day moving average, and what do you notice? Well, we continue our nearly sheer vertical ascent. Last week or so, we've had some hiccups in the market. It is still the spooky season, so I'm not surprised to see this happening right now. But if you look at where we are, I mean, we continue to be in an extremely strong uptrend. 50 days upward sloping, 50 days now around 642 on SPY, 200 days upward sloping. This looks great. This is a really strong uptrend and continues to be one. I would not be surprised if we see some consolidation in the spooky season, at least until third week in October. If we don't get that, though, remember, that's also a good piece of data that tells us that this rally is much, much stronger than even seasonality would have us believe. So let's talk about the Fed. Let's talk about one of those things that's fueling this rally, causing that most recent spike that we saw in the market. Federal Reserve cut interest rates. I want you to pay attention to the dates here. September 17th, the Fed cut short-term rates to a target range of 4 to 4.25. So what did they give us? They gave us a quarter-point cut. And the last time that we spoke, I mentioned, I think a quarter-point cut is all we're going to get. We also got the dot plot, and normally I like to show you the dot plot, but I'm skipping that this time because it's just a bunch of dots on a page. Interpreting the dot plot, though, is pretty interesting. There's some thought that a lot of the Fed governors, if you look at what's being said in between the lines of the dot plot, this cut that we may have just gotten, this may be it for the end of the year. I think there's 7 Fed governors now that say no more cuts until the end of the year. Rates are where they need to be. So it's possible that we could be looking at a one and done rate cut here, particularly if inflation and tariff effects, start to heat up in the back part of as we get towards the end of the year. So it's pretty interesting. So it was a cut, but it was hawkish in how it cut, and a lot of discussion around this rate cut has basically been, hey, this might be a one and done. This might just be to get Trump off their back sort of thing. So we'll see. More interesting, though, remember that date, September 17th, when rates were cut. What I'm showing you here on the screen, this is the U.S. 10-year Treasury rate. And I'm showing you that September 16th, the day before the cut, was pretty much, there was a little bit of a lower low, maybe 3, 4, 5 sessions earlier. But September 16th looks to be the low for the 10-year Treasury at around 4.02. And if we look at where we are today right now, we're just about at 4.2. So interest rates have moved almost a quarter point higher on the 10-year Treasury since the rate cut. And you are not mishearing me. We did have a rate cut. That rate cut came at the short end of the curve, a quarter point down. But what we're seeing, the effect of that cut is the long end of the curve, 10-year Treasury, 30-year Treasury, that has had a quarter point increase in the rate. And this is important because things like mortgages, auto financing, all the big stuff that we really want to stimulate is all running off of this 10-year Treasury. And this was an effect, we've talked about this a couple times before, the Fed does not control the long end of the curve. The long end of the curve is going to do what it does based upon what the Fed does at the short end. And it's very interesting. Every time we've done a rate cut, the long end of the curve goes higher. And so the stuff that we're actually trying to stimulate, housing construction, vehicle purchases, factories, etc., the stuff that we actually want to stimulate is not being stimulated. And in fact, it's almost counterintuitive. We're making these things more expensive the more we cut rates. I think this is one of those symptoms of cutting rates when inflation is as high as it is. It's very atypical what we're doing. And so I think the market is trying to, make peace with that. And you can already start to see, this rate relief is needed. I'm picking on Lennar here, but you can basically go to any home builder. Lennar had pretty good earnings. They got a boost from, they got some ownership in Open Door. But if you look at what was inside the earnings announcement, they basically said, hey, the amount of finished homes, our backlog, the amount of units that we're going to deliver, all this stuff is coming down. We're seeing very severe margin pressure, stuff that's coming through, in tariffs. Home builders are very exposed to this. And this is really the heartbeat of the economy. So we have an industry that is tremendously economically sensitive, that is basically the fulcrum for the rest of the US economy that isn't just AI data centers. They need some rate relief and they're not getting it. And in fact, rates are kind of going the other way. It's an interesting brew. So what does it all mean? Rates dropped, ? Well, as expected, the Fed cut rates a 1/4 point. That's good. The dot plot seemed to suggest that there won't be many more follow-up cuts. That's interesting. And it opens this idea of maybe a one and done to get Trump off our back. The long end of the curve has risen since the rate cut. That's not good. Where we need the most acute rate relief is actually in the long end. This means that large durable goods, auto, housing, furniture, factories, you name it, will not be seeing rate relief anytime soon. Very interesting brew that we've got going on here. What I think the long end of the curve is going to wait and see what the end of the year looks like in terms of inflation readings. Right now, the tariffs are being eaten by corporate margins. How long are corporations going to wait before they start passing through those cost increases to consumers? And I think that's where this rate reduction cycle is going to get very challenged. So there you go. Rates dropped. The market looks great, but we're starting to see there's some challenging developments here. We'll see how the financial system deals with it. I'll see you next week for the news review. Take care. Okay, friends, that was the video. Hope you liked it. If you found it informative, good, entertaining, I'd love if you could scroll down here beneath the video and give me a like there. It helps us out with the algorithm. And then if you want to be notified first of anything new that we upload to the channel, if you come over here, click subscribe, you'll be the first to know as soon as we upload anything. Appreciate it. See you soon.